Times it's hard to believe what to understand, and it's hard to understand what to believe because you have a lot of things going around in the general population where people are talking through mortgages and finance, and they're not experts, they're not qualified professionals. So today what I want to do is explain in a level of detail how much a mortgage really costs, the criteria that banks look at, and things that you need to consider if you're thinking about getting a mortgage. So instead of going to family and friends and asking people questions that can't really answer it in a way that a professional can, you can listen to this video and you can get the information that you need to make an informed choice. Make sure that you watch until the end because everything that I'm going to cover off is really important. So you're probably wondering, how much does a mortgage actually cost? What is the criteria that I need to cover off? And what does the bank look at? Those are all the things that we're going to be covering off today. So it's not what you think. I find that people tend to think that it's about how much they make and their credit score. Those two things are important, but it's also about your credit profile and a process that I call CID. So it's credit, income, deposit. Remember, your home is at risk if you do not keep up the repayments on your mortgage. And this video is not to replace speaking to a qualified professional. I'm not giving tax advice, legal advice, or financial advice, just talking through how mortgages work. So I have something that I call CID, CID, which is credit, income, deposit. So credit, how have you managed your money? It's really important how you're managing your finances. A bank is going to need to understand that before they can do a mortgage. Your income, how is your income made up? Are you PAYE? Are you self-employed? And deposit. So credit, income, deposit. So as far as your credit, don't just think about your credit score. It's about your credit profile. Have you missed any payments? Do you have any CCJs, defaults, payment arrangements? In the last 12 months, have any of these things happened? They're going to also look at your income. So your income is not just about how much you make, but it's how your income is made up. So a self-employed person is going to have a different process than someone that's PAYE. And your deposit. Deposit's super important. We're going to cover that off. The reason why it's really, really important is, how did you build up your deposit? Did you get your salary and then you put your salary into a savings account? Did someone gift you some money? It matters. How you built up your deposit matters. So it's not just about the size of your deposit, but it's also how the deposit was built up. First, let's look at your credit. As I always say, it's not just about your credit score, it's your credit profile. So they're going to look at things like missed payments. They're going to look at CCJs. The CCJ is a county court judgment. It's not that uncommon that when I look at someone's credit report, they have a CCJ on there that they weren't even aware of. So it's important to check your credit report regularly. They're going to look at if you've had payment arrangements. So have you owed someone some money, been in arrears, and they've said, you know what, let's just make an arrangement that is more affordable to you. These are things that lenders are going to look at, and your overall financial behavior. The truth is that during COVID, a lot of people were hit financially. So banks do understand that during COVID, things changed for a lot of people. But what's happened since then? They're going to look at your overall credit behavior. So your credit is important, but it's not your credit score, it's your credit profile. The next thing that they're going to look at is your income. So how do you get paid? How do you make money? So you do need to have an income in order to get a mortgage. It doesn't necessarily have to be an employed income. They will look at some of the elements of benefits, but you have to be able to repay the mortgage. So you have to have something coming in, whether it be investment income, dividend income, or, as I said, an element of benefits. These are the things that they're going to look at and you're going to need in order to get a mortgage. So they'll assess your salary, bonuses, overtimes, commission, self-employment, pensions. The thing to think about is some people will approach me and they have a second job. So they have a second job. So let's just say on their first job, they make £50,000 a year. And then they have a part time job, they're making 12, £15,000 a year. One thing that a lot of people don't realize is that that second job income is not always going to be included in the income affordability assessment. So sometimes a lender will say, well, you know what, we'll take 50% of that second income, or we'll take 25% of that second income. And if you've just started the second job, they may not take any of the income because they want to see that you didn't just get the second job in order to be able to qualify for a mortgage. They want to see that it's something that is sustainable. So your income and how your income is made up is important. If you're self-employed, it's a little bit more tricky because as a self-employed person, you're going to need at least 1 year's SA 302 and tax overviews. In many cases, it will be two, but there are lenders that will accept just 1 year's SA 302 and tax overviews. So you have to have filed your taxes. One of the things that confuses people is they'll go to their accountant, and the accountant's job is to be tax efficient. So to make sure that they can legally write off everything that they can write up to reduce your income. But that's antithetical to what a mortgage broker needs. A mortgage broker and a bank need to see a high income. So you're making a lot of money. So when you are doing your taxes, make sure that you're dealing with an accountant that obviously is going to do the right thing. But if you're looking for a mortgage, have the discussion, understand as you're getting up and running. Don't wait until you are looking for the mortgage and then go to the mortgage broker and say, how much should I show? That's not what we want to hear. We want you to show what is actually correct, and the number that you have filed with HMRC is the number that matters. So your income is important, how it's made up is important, but the other thing that's really important is your deposit. The deposit is going to be something that they look at, not just how much it is, but how the deposit has been built up. So the deposit is going to impact what they call the LTV, or loan to valuation. So the LTV is the percentage of the value of the property that the lender is lending. So we have a really good example here. An example of LTV would be the house costs 300,000. Your deposit is 30,000. So you only need to borrow 270,000 pounds from the bank. So it's 300,000 minus the 30,000 pound deposit. So you have a loan or mortgage amount of 270,000. That means the LTV is 90%. So you've paid down, in essence, 10%. People get fixated on this whole thing of 5% down and 10% down. Don't get fixated on that. And the reason why I explain it this way is because the amount that you have in your hand is the amount that you have in your hand. It's not a percentage, it's an actual amount. So when you speak to a mortgage broker, we will ask you, how much do you physically have that you can prove with a bank account? If you come back and say, I have 5%, it's not helpful, because if you're buying a house that, as we just did in the illustration, is 300,000, then 10%, let's just say, is 30,000. But if you're unable to find a house at that price point, and let's just say you're at 310,000, then all of a sudden that same 30,000 pounds that you have is no longer 10%. So don't talk in terms of the percentage of deposit. Talk in terms and communicate with your broker in terms of how much you physically have. The other thing to keep in mind with that is threshold. So between 90 and 95%, that is a product class. Between 85 and 90%, it's another product class. So what you will find is sometimes by paying down 500 pounds extra, it might put you in a different product class, and it will change the loan to valuation, which will impact the rate. So that's a quick tip. So with your deposit, a larger deposit is generally going to mean a better interest rate. It's generally going to mean more lender choices and lower monthly repayments. And that makes sense, because if you pay down more, then you're borrowing less. The less you're borrowing, the less risk it is to the bank. And risk is what reflects the rate. So the risk, the higher the risk, the higher the rate in most cases. So think about it this way. If you buy a house and you're only paying down 5%, you're getting a 95% mortgage. There's risk to the bank because if your property price drops, then all of a sudden you don't have that equity. That's when people are referred to as being upside down. So they owe more than the house is worth. So if you buy a house with a small deposit and your property value goes down, you could be in what they call negative equity and be upside down in your mortgage. And that's risky to the lender because if for any reason they need to foreclose, it then means they may do that at a loss. It won't be at a loss to them overall because they'll make their money, but it will be at a loss to you. So the higher the deposit that you put down, the less risk it is to a bank. And because it's less risky, it also means that the bank will, to a degree, reward you by giving you a more favorable interest rate. So we've looked at credit, we've looked at income, and we looked at deposit. Here are the three questions that every lender asks. Credit. Can we trust you to repay this? And it's not just about trust, as in, do you have the intention to do it, but do you actually have the means and ability to do it? So, this is where the age factor comes in because if you're about to retire, they're not going to be looking at your income while you're working, they're looking at your retirement interest or your retirement income. So if you are over 58, 59, definitely make sure you speak to a broker while you are looking for a mortgage. Don't go directly to a bank because when you start to reach close to retirement, your income is going to be assessed on your retirement income and not your working income. Now, this will be impacted by the type of job you have. If you're a bricklayer or have a really physical job, then lenders know that you're not going to be able to work until you're 85 in most cases. So if you have a very strenuous job, you will find that the term in which you can borrow over may be shorter than someone that has a less strenuous job. So they will look at, can you repay? The other thing that lenders are going to look at is your income. Can you comfortably afford the payments? So can you comfortably afford the payments? Lenders are there to lend responsibly. They don't want to put you in a situation where you cannot meet your monthly expenses. So they're going to look at affordability. They're going to look at how much you have coming in, and they're going to look at how much you have going out. They look at something that's called the Office of National Statistics. So if you're in a household with two people and you have three kids, there's a certain percentage that they're going to deduct from your affordability because they're going to say you need to run the house, you need to have gas, electricity, you need to have food, things of that nature. So you can't just put a figure. They're going to look at what the national average is, and that's going to vary depending on what part of the country that you're in. So they want to make sure you can afford the repayments. And for deposit, they're going to ask, how much risk are we taking? As I covered off, risk is going to reflect in the rate. So they're going to look at how much risk can they take. Are they going to lend you with a 5% deposit? Or do you need to come up with a greater deposit? What you will find is if you're paying down 15% or more, it makes it a little bit easier to get a mortgage, even if you maybe have had some credit bumps. Conversely, it may be because you've had credit bumps, you need to pay down a little bit more. So those are the things that a bank is going to look at in order to assess how much you can afford for a mortgage and therefore how much they will lend you. The other thing that you want to think about is it's not just about income. So it's not just about income. Two people can make the same salary and get different outcomes. Why is that? Because two people aren't going to have the exact same circumstances, same outgoings, same commitments. So don't do this thing where you go and talk to your friend and your friend is like, "Oh, we got a 5% mortgage." And then you're saying, well, we're about on the same amount as in our income, and we didn't qualify for a 5% mortgage. Every aspect of the application and your profile is going to impact what kind of rate you get. Lenders also look at existing debt, age, type of job, type of income. Is it PAYE or is it self-employed? Income's important, but affordability is what matters. So you could be on 90,000 a year, and when you get your salary each month, all of it's going out the door. whereas somebody else could be at 60,000 and have very low expenses. So it's not just about your income. Why your mortgage rate isn't the same as someone else's. So many buyers ask me, why is my friend getting a lower rate? As I said, they might have a better credit history, larger deposit, lower loan to valuation, which we explained, the LTV, different lender. So this is why it's so important that you go to a broker and not just directly to the lender. So you might hear your friend say, oh, well, I got a better rate, or I was able to get more on my mortgage. And it may just simply be because they went to a mortgage broker. The mortgage broker assessed that individual's circumstances and was able to find the lender that could give them the best product based on their individual circumstances. If you go directly to the bank can only give you their best rate. Whereas if you go to a mortgage broker will scan the market, find the product that fits best for you, and then place you with that lender. The other benefit of working with a mortgage broker is they're going to support you with some of the admin. So people are under the impression that paying a mortgage broker is money out of your pocket. But in the long run, it usually is going to save you stress, it's going to save you time, and it's going to make sure that you're comparing the market. I don't understand this idea of going directly to the bank because we don't do that with anything else. Everything else that we're looking to purchase, we shop around. We go to compare the market. We go, but when it comes to paying a broker versus going directly to your bank, people are like, no, I don't want to pay a mortgage broker. I'm going to go straight to my bank. And some people actually think because they're a vanilla client. So a vanilla client is someone who good credit, good deposit, stable job, UK passport, pretty much anyone will lend to them. So they figure, well, why am I going to pay a broker when I know anyone will lend to me? Well, that's the point. Because you are a good customer, you're going to have more choices and there's going to be more products that are available to you at more favorable rates. Don't go directly to your bank. Make sure you speak to a mortgage broker. And this is why your rate will not be exactly the same as somebody else's with different circumstances. So, what can increase your mortgage cost? Let's just go through some of the things that are going to make the mortgage more expensive. So, number one, CCJs and default. So, CCJ is a county court judgment. A default means that you've stopped paying for a prolonged period of time and the lender has sold that to a collections agency. Missed payments, high credit card balances, small deposits, high existing debt. This doesn't always mean that you'll get declined, but you'll have fewer lenders. So let's just go through that. So if you have CCJs or defaults, right away, there are some banks, mostly the high street banks with the best rates, they will not lend to you. If you have CCJs, defaults, missed payments, specifically over the last 12 months, if it's 24, 36 months or more, you still want to make sure that the broker checks with the lender. But what you will see on some lenders' criteria is they will not accept an application if someone's had CCJs defaults in the last 12 or 24 months. Now, a default is an interesting one because you may have had a default, but you may have satisfied it. So that means you may have paid the default. So you owed the money and you paid it. The credit report will reflect that you've paid the money, so it will show as satisfied, but it will also show that that payment was in arrears. This is why looking at your credit report will give you insights into what the bank is seeing. So get your credit report from checkmyfile.com. Checkmyfile.com. I don't get paid to say that, but it's the easiest credit report to read. And it's also a combined credit report where you'll see all three credit reporting agencies. It's a bad move to just pull your Equifax or just your Experian or just your TransUnion because not every lender reports to every credit reference agency. I've seen it time and time again. Someone just checks their Equifax, it looks fine. When we do their check my file credit report, then we see that on the Experian report, there's something there that wasn't on the Equifax. Or sometimes the timeline is different. So on your Equifax report, it might show that you missed a payment in January. On your Experian, it may say February. And that makes a difference because, as I said, lenders will sometimes look at a 12-month period or a 24-month period. So that January to February may make a difference as far as you even being able to get an agreement in principle. So these things matter. CCJs, defaults, payment arrangements, missed payments, late payments, the lender looks at something called the status. So if you've missed one payment on your credit report, it will show as a status one. So there'll be a one on your Check My File credit report. As I said, it's really easy to read. Some lenders will say, well, we'll accept one status one over the last 12 months. Others will say zero. Some will say we'll accept a status two. But these are the things that are going to make the mortgage more expensive if you don't resolve them. That's why speaking to a mortgage broker before you're ready is very useful. Because if you speak to the mortgage broker before you're ready, you can tidy these things up. If there's an error on your credit report, you can fix it before you get going, because the lenders look at what's on the credit report. So that's the Bible to them. I'll say that again. The lender's going to look at what's on the credit report. You may have a very reasonable, very acceptable explanation for why it's an error, but the lender's just going to go by what's on the credit report. So if there's something that's on there that's an error, or something needs to be explained, or something needs to be removed, make sure you do that before you apply for the mortgage. Because although you'll be able to explain it to me, and if it's a manual underwriting process, then I can explain that to the underwriter, it's still going to end up probably costing you a little bit more in your mortgage, because you're going to be paying a higher interest rate. So those are some of the things that will make your mortgage more expensive. What can reduce your mortgage cost? So this is kind of the flip side. This is the flip side of what will make your mortgage more expensive. So what can reduce the mortgage cost? So one of the things that can reduce the mortgage cost is paying down debt. Another one is savings in a larger deposit, improving your credit profile, registering on the electoral roll. That's an important one. Correcting errors on your credit report. So these things are going to make it less expensive for you. Something as simple as being on the electoral roll. So when you get that letter in the post, don't throw it away. Make sure that you do register on the electoral roll, because believe it or not, it can make getting a mortgage a little bit easier. One of the reasons is because they can identify you and verify address easier. And I've worked in collections for over 10 years. So for a decade, in my 30 years experience, I worked in collections, and little things like being on the electoral roll, making sure that you pay down small debts, higher savings, are going to make your mortgage less expensive. And here's a tip, and this comes from my collections era. Sometimes there'll be an error on someone's credit report, and it will genuinely be the error of the credit card provider or the cell phone company. And people will take a stand, a moral stand, and say, that £235, I don't owe it, therefore I'm not going to pay it. Let it default because I'm right. Bad move. I've seen it time and time again where people will just, dig in, and that £235 goes to default, and it ends up costing them thousands or tens of thousands of pounds, simply because it means that either they can't get a mortgage, or the mortgage they get is at a higher rate. So for the sake of £235, I've seen people go up a whole point in interest rate because they are taking what they consider a principal stance. So I would say pay, then dispute, which leads me to another interesting thing. Pay and then dispute. It's another phenomenon that I see where people are like, I'm not going to pay until it's resolved. Quite frequently, it's just because they can't afford to pay, but they'll say, there's an error. This is too high. Pay and then resolve. The reason why I say that is the only person it's going to impact while it's on your credit report is you. It's not going to impact that company. It's not going to impact the person that you're upset with on the other end of the phone. It's going to impact you. So pay it, keep your documentation, and then dispute it, because that way it can be removed. You get your refund or whatever, or even if you don't, for the sake of £235, you don't want to end up getting a default or a CCJ. So pay and then dispute. I'll tell you that one for free. So these are some of the things that can reduce your mortgage costs. And it's important that you look at these things holistically, because it's not a one size fits all, because you could pull one lever by paying a default, but then you miss a payment somewhere else. So you want to make sure that you're looking at your credit and your credit overall profile as a holistic thing and something that goes together. So the biggest mortgage myths, one of my favorite topics. There's lots of mortgage myths. A lot of them come around from either people not knowing and putting things on TikTok, or things that used to be true that are no longer true. So I was declined. Someone said no. So that means I can't get a mortgage. So no doesn't mean never. No doesn't mean that you aren't mortgage eligible. Or maybe you went for an agreement in principle and you didn't get the agreement in principle. Not getting an agreement in principle is not a mortgage decline. So don't make that mistake. A If you're going for an agreement in principle and you're doing it online and you're not doing it through a broker and it's not successful, it doesn't mean you have a mortgage decline. So on your next application, when it asks, have you ever had a mortgage decline, please don't say yes, because it's not a mortgage decline. But you can avoid that by actually going to a mortgage broker, because the way that we work, before we do the agreement in principle, we'll actually check the criteria. We'll request your credit report from you so we can look through it. So we won't even go for the agreement in principle with a lender that wouldn't accept, one missed payment in the last 12 months or whatever we see on your credit report. We're going to make sure that we go to a lender that you meet the criteria for, so we can get you that agreement in principle. So you want to have that conversation with your broker in advance. You want to go through the information and be very open and honest with your broker. That way your broker knows which lender to place you with, that you don't have any needless credit searches or needless agreement in principle declines. You can go to the broker. We can help you avoid that. So the things that you want to think about as far as myths are, no doesn't mean never. Another myth, and this is kind of a side issue, another myth people have is my credit's bad because of my address. There's 5 people that lived here before, and therefore my credit's bad. I'm not sure where that came from. Maybe that was true 30 years ago. I don't know, because I've never seen that be the issue. Your credit profile is based on you and the applications you fill in. The other thing that some people don't know is your credit profile can be impacted if you have a financial link with another person. I see this a lot when people maybe are living together or they're in long-term relationships and they take out credit together. What happens is that creates a financial link on the credit report. So that can impact your credit, but just being at an address is not going to impact your credit. Check your credit report regularly, and you can help remedy and avoid some of the issues that you might come across as far as errors on your credit report. Make sure you don't miss payments. Best idea is to have a direct debit set up on things. Review your direct debits regularly, because you can sometimes have something that you no longer need, or you're paying for something twice. So you might have a packaged bank account that gives you breakdown cover, and then you're also paying for breakdown cover. So checking your credit report can help you tidy up your credit profile. It can also help you reduce your outgoing. So it's just a good exercise once a year. I would say twice a year. So in January, when you're preparing for the year, halfway through the year, to just assess where you are with your finances and manage your budget a lot better. The other things you should do before you apply. So before you apply, here's a checklist of things to do. Make sure that your credit profile is strong. Check if you've reduced unnecessary debts. Check if you have the right evidence of your income. Have you have the largest deposit? So things like saving through a lifetime ISA. If you don't have a lifetime ISA, make sure you check it out. So a lifetime ISA is a really good product if, and I stress if, you are looking to buy your first home in more than a year. So a lifetime ISA is a great product if you're looking to buy your first home in more than a year. The lifetime ISA is designed for you to be able to buy a house and save money. So the products that are on the market now, and I'm not endorsing any specific product, I'm just telling you how the product works. They have a product where you pay in £4,000 for the year. So that would be the maximum contribution to the lifetime ISA. And you get £1,000. So you put in 4, you get 1. The key thing is a lifetime ISA is for the purpose of purchasing a home. So if you're not doing it to purchase a home, or you're looking to purchase a home in less than 12 months, then it's not going to be a good product for you. And another thing to keep in mind is that the lifetime ISA is the money doesn't go to you. So when you're making the purchase, you may have 20, 30,000 pounds in your lifetime ISA. That money doesn't go to you. So if that's the full deposit that you have for the property, make sure that you have another bank account with some money in it to pay broker fee, legal fees. You might need to pay a product fee, valuation, some of the other fees and costs that are involved in purchasing a home. Make sure you have that money that is liquid and accessible in addition to the lifetime ISA. But by having a lifetime ISA, this is something that will make your mortgage cheaper, hopefully, and make your life a little bit easier. But ask yourself those questions. Have you talked to a broker? Have you tidied up your credit? If you do it the other way around, so if you actually speak to a broker like myself, we'll go through this checklist with you anyway. And if you speak to a broker 6 months before you're ready, then all of these things can be fixed by the time you're ready. So a quick way to assess how much you can borrow. Many of my appointments, the first thing that people want to know is how much they can borrow. And often they've been misled by Zoopla or Rightmove. So when you're looking for a property, you go on Zoopla, you go on Rightmove, and they have that calculator at the bottom. The calculator is not based on you. So it's just broadly giving you a figure. It's very rare that that figure is actually accurate because it doesn't take into account things like, are you self-employed? It doesn't look at if you're on a skilled worker visa, have you had a default? It's just doing some quick math. But let me give you a formula that's way better than what you will see in Rightmove or Zoopla. So what you do is you take your income, combined income, if there's two people on there or three people, take the combined income, multiply it by 4. So multiply it by 4. The number that you get is the amount that you can borrow in most cases. You then add the amount that you have for your deposit. So let's just say you could get a mortgage for 300,000, but then you had 30,000 pounds in savings for the deposit. That's 330,000 pounds. So that means roughly you could purchase a house for 330,000 pounds. Why? Because your income will support a 300,000 pound mortgage. The house is 330,000 pounds. You're paying down 30,000 pounds. So you only need a mortgage of 300,000. You might see other people online talking about 4.5 times income multiple and 5.5. I try to avoid that on the first conversation because there are a lot of things that will impact if you qualify for higher than a 4.25 multiple. So your credit, the loan to income, the loan to valuation, all of these things will impact that. But if you want a ballpark figure of how much you will qualify for a mortgage, just take your income, multiply it by 4. I tend to do that exercise at the very beginning of the call so we can get a feel, because I know if someone has a 30,000 pound deposit and their income will only support a 300,000 pound mortgage, but they need a 600,000 pound house, I'm not going to waste their time because they're not going to be able to get it. Higher income multiples are usually attached to people that have really good credit scores, good income, PAYE, UK passport. I'm not saying that it's impossible to get it otherwise, but it's less likely. So before you speak to a broker, go out, find a house that you and your family would actually want to live in. See if that is going to be within the realm of possibility based on your income. And yes, you do need an income. Surprisingly, I have people that contact me and they have no income. They're like, well, I was working 4 months ago and I used to make 80,000 pounds a year and I need a mortgage now based on what I was making when I was working. It doesn't work like that. So you are going to need an income. That quick formula is going to probably save you some time. Now, if you talk to me, I will be able to give you a pathway forward to get to where you need to be. But if you're, 100,000 pounds out as far as what your income can support mortgage wise, if you're that much out, it's probably going to be something where either you need to reduce the aspiration as far as the house price. Maybe you need to get a starter home and then move up, or maybe you need to wait a little bit longer until you have a higher deposit. What we've done is we've gone through credit, income, deposit, and a little bit more. I have a book. It's called A Mortgage is a Really Big Loan. It's a great book for young people. It's also good if you know someone who has recently moved to the UK and is trying to understand how finance and mortgages work in the UK. Or if you're just a regular person, they don't teach these things in school. The way that the book is written, it's written the way that I speak. It's very plain talking, giving examples based on my 30 years of experience in finance. It's available on Amazon. Please support me by getting the book, and you can gift it to someone. If you have young people that are going away to university or just getting married, it's a great wedding gift. You might be wondering, how do you prepare? So, how do you prepare for a mortgage? How do you prepare to speak to a mortgage broker? It's really easy to prepare to speak to a mortgage broker or to get a mortgage. First thing you want to do is make sure you tidy up your credit. So, look at what you're paying out, make sure that everything is in line with what you think you're paying out. Anything that's unnecessary, get rid of it. Another tip, and I didn't plan on saying this, but another important tip is make sure that anything that you're paying out, as far as the reference that you put beside it, is not something dodgy. So I had a friend, young guy, and he had gone out to eat with some friends, and someone paid for him and he had to pay them back. When he was paying them back, and he put that reference as far as what the payment is for, he put something just inappropriate. And when we were doing the mortgage for him, that came up. They're like, well, what is this? And because of what he put, they questioned it. The mortgage went through, it was fine. But what I'm just saying is they do look at these things because you are going to need to provide 3 months bank statements. So, as far as preparing, make sure you have 3 months bank statements, the most current 3 months, go through it. Make sure you have 3 months pay slips. So, if you paid monthly, you need three. If you paid weekly, you need more than three, but it's three of the most recent months. You might want to look at the deductions that are on your pay slip, look at what your net income is, and understand what your actual salary is. I don't understand how I can speak to so many people and you ask them what their salary is and they have no clue what their salary is. So get a feel for what your actual salary is. Make sure you check out your contract. Are you fixed term? Are you self-employed? Are you 0 hours? All of these things make a difference. You're going to need proof of your address. So that's usually a utility bill, or it might be a council tax bill. A lot of lenders won't use a bank statement as proof of address because you're using that as proof of income and how you manage your finances. If you're on a skilled worker visa, so if you're on a tier two visa, you'll need the share code. It's the one that starts with an S. But most importantly, make sure you go through your credit report from Check My File. And the reason why, as I keep saying, Check My File is going to give you a full overview of your credit activity. It's going to look at searches. So you might find that someone's been doing searches. You might find that someone's opened up an account in your name and you are unaware of it. But do these things first. Speak to a mortgage broker. Make sure that you're open and honest, and you'll be in a good position to get the very best mortgage that you qualify for. Speak to a mortgage broker 6 months before you think you're ready. Why do I say before you think you're ready? People tend to do it backwards. It happens. I get these calls. I get someone watches a video and then they come to me and they say, I've had a mortgage offer accepted with a seller and I now need an agreement in principle. That's the wrong way to do it. That's so 2020. All right. So the way that you need to do it is go to a mortgage broker and assess how much you can actually borrow, get an agreement in principle, and then go and search based on your budget. If you do it the other way around, you put yourself in a not too good position. And here's why. If you go out, do the negotiation yourself, you're probably going to end up overpaying because estate agents know how to negotiate. You might think you're, a boss at negotiating, but they do it every day. And an estate agent's job is to get you to pay as much as possible on behalf of their client, who is the seller. They work for the seller. They don't work for you. So no matter how nice and friendly they are and how much, they try to get you to be really casual with them, they work for the seller. And when you're selling your house, you want someone that's working for you and is going to squeeze every penny out of the buyer that is possible. So remember, they don't work for you. They work for the seller. So this is why you should probably have the broker negotiate the deal. But if you have gone out, you've got an offer accepted, then you go to the broker. What if you can't get that mortgage? But more importantly, it just puts a lot of stress on the broker to move things really quickly. Or you'll just go with the broker that the estate agent introduces you to, and maybe you end up paying more, you lose service. Quite often there's a conflict of interest. Make sure you do a search on that. It's called conditional selling. So some estate agents will position it that you have to speak to their broker. That is not legal. That's called conditional selling. So make sure that you speak to a broker. And when you're speaking to the estate agent, you can say, well, I already have a broker. I have an agreement in principle. This conditional selling thing is important because if you use the broker that the estate agent refers you to, they may disclose things to the estate agent that maybe you don't want them to know. So you may qualify for £250,000 mortgage, let's just say, and you're trying to negotiate at the 230 mark, but that broker who works with the estate agent has already told them that you can do 250. So my best advice is do not use the broker that the estate agent refers in most cases, and don't use the solicitor that they refer. What you want to do is have your own people. But more importantly, you want to have your broker before you go out and look, that you can make sure that you buy within your budget, and also they can support you with the admin. A good broker is going to save you time and save you money. That's why you want to talk to them 6 months in advance. Brokers work with multiple lenders. We have specialist lenders. So if you've had credit bumps, don't rule yourself out. Don't think because you've had a CCJ or a default or even a repossession, don't think you won't be able to get a mortgage. There are specialist lenders. Okay, it is going to cost more. So the rate reflects the risk, or the risk reflects the rate. So you will pay a little bit more, but you can't compare a high rate from a specialist lender who will lend to you to a low rate from a high street lender who won't lend to you anyway. So what you can do is you've had a bump, you need to get this mortgage, you get the mortgage, you do maybe a 2-year fixed and then pay everything really well. And then when you go to remortgage, it may be that you qualify to be with one of the high street lenders with the lower rate. But if you've had credit bumps, don't rule yourself out. Speak to a mortgage broker. We work with specialist lenders. Specialist lenders are lenders who will assess your application manually. They will lend responsibly, but they will lend at a higher rate. You might have to pay some additional fees, but you can get that mortgage even if you had some bumps. Speak to your broker, be open and honest. My name is Anthony Lindsay, and I make these videos that I can explain mortgage related products. I don't do this to replace speaking to a qualified professional who understands your specific circumstances. So make sure you speak to a professional. If you'd like a free mortgage capacity report with me, not a PA, VA, this is not a sales funnel, but if you actually want to speak to me, you can use this QR code, which is right here. Use this QR code. You can book an appointment. It's free to speak to me. I don't pressure you. I don't cross-sell, upsell. All I'll do is see how much you can afford to borrow. If it's less than you need to purchase now, I'll give you a clear pathway to how to get to where you need to be. I make these videos to support you. So if you've watched any part of this video, if you've enjoyed it, make sure that you like and share. Make sure you tell friends about it. And it's not to replace speaking to a professional, because this is just general guidelines on how mortgages work based on my 30 years of finance experience. It's a small channel. It's growing. So if you do like it, if you have a comment, or if you have a topic that you'd like for me to talk about, please put that in the comments, because it tells the YouTube algorithm that what I'm doing is valuable. And I usually pick my topics based on what people are saying to me regularly, or questions that people are asking, or things that are going on in the news. But if you have a topic that you'd like for me to discuss, or something that you'd like for me to cover in one of my videos, just put it in the chat. I'd really appreciate that. Thanks for watching, and I'll see you next time.